Good morning, ladies and gentlemen. And it's now in the first week of January, beginning to be quite obvious that what I've been warning about for a few weeks in December, and that is a seller's strike with outsized move to the upside, is coming true. This is a monthly chart of the S&Ps, and as you can see, in 4 trading days, we have managed to get to the top of the Bollinger Band for the whole month. If we just try to enlarge this, we can see the huge disconnect we have with the moving average, that the exponential moving average that the monthly nearly always tags. And we can see that we are at the top of it. It would not surprise me in the slightest if we went at least a couple of percent above it. So the top of the Bollingers is 2750. A couple of percent actually takes us to 2800. Complete move, seller strike going on. The volume is negligible. There are no sellers. People who are holding equities are holding them. They see no reason to sell them, and that is reflected in every single time frame, as we shall see now. On a weekly chart, things are even more overbought. If we just try to have a look here, we are above the weekly's top Bollinger. It'll come in somewhere around 2750 next week. That will be a very interesting level to see the battle going on, but it is more likely than not to bust through it, and then at some stage after a couple of weeks battle probably come back down and tag this weekly exponential moving average, if not the red one, which is at the moment all the way back below 2600. So what we're saying is that when the sellers come in, and nobody can tell when the sellers will come in, we will have a a very, very nice retracement, because there are going to be no buyers until we tag these lines. So the question is, how long is a piece of string? Well, we can only be guided by the past, and that is what we are going to have a look at next and see historically when these buyer strikes have taken place. What did the price action look like? On a fundamental basis, you can see where we are. We are now well over 19 times forward earnings, and we are just vertical. It is certainly acceleration, and it's the acceleration that we've been waiting for to give us a sign of a top. It is happening. The only question is, how long does it persist? Would not be surprised in the slightest, and then we can shift to a monthly time frame to see something like this. This is the 20 times line, which in 97, 98 got absolutely pulverized. The market came back to it and then had one final spike before things went back to normality, and we tagged the 15 times Blue Angel in late 2002, 2003. So you can see how long a cycle that is, and what are the possibilities here? Well, the possibilities are that we go all the way up to 2800, over 2800 and 2900, and then we come back down to 2600. You can see how big these changes are, and you can see how if that is really what is going to take place, and I have no doubt that it will, how cheap actually volatility is on the upside and on the downside. Our main question really has to be, which sector of the market is left that can take us that much higher? Well, we know what the large sectors in the S&P are. Discretionary is one of them. Can discretionary get to 24 times forward earnings? Yes, no problem. Done it in 99 and 2000. It just got over it. So yes, we can have a little bit more from discretionaries, certainly enough to push the index higher a couple of percentage points. Staples are the ones that are getting sold, but on a rotation they can certainly go higher to 24 times. Energy is a very small component, but nonetheless not the one that I would expect to drive us higher. But here we are, financials is one that can definitely drive us higher. In 98, 99 and 2000, it hugged the 16 times Blue Angel, and we still have quite a bit of room. We could be tagging it for quite some times on the upside, and that could certainly take us a couple of percentage points in the index without any problems. But the main one, healthcare, is also has also quite a bit of room on the upside to tag, but the main one is not industrials. The main one is technology, which I keep on referring about. XLK is America, and you can see how XLK could have a total acceleration. I would not be short of Nasdaq at any stage. It's just not worth it. We could have a real acceleration in XLK in technology, and it could go easily to the 25 to 30 times. So that is a 20% move in technology from here, which I could easily see, and a 20% move in something which is a third of the index in the S&Ps is a lot of points. So the upside is certainly favored, and the fact that volatility is now still so cheap is the way one should play it. I've been showing you this chart for well over a year. The fact that the market is now right at the top of this trading channel, and that the volatility is so cheap compared to the level that we are, it is incumbent upon us to do some option strategies rather than outright trades. Buying straddles around the 2750 area is definitely the way to do it, and we'll have a look at it in the moment. What is very interesting is this chart of XIV, which is the inverse of VXX. It is failing to carry through on the highs, while the market kept on going higher on Thursday and Friday. XIV could go no higher, and in fact the Bollinger Bands are now tightening, indicating a period of possibly higher volatility in XIV, which would translate naturally to a period of higher volatility in the VIX. So really it is silly to try to measure the length of a piece of string, because it could get very, very ugly on both the upside and on the downside. Believe me, when the sellers actually do come in the S&Ps, you probably won't see it for 75, 100 points. And that is why options which are pricing the volatility of the next 2 weeks at no more than 1 to 1.5% become very interesting for both the upside and the downside. Here we have the 2750 straddle in end of month, so January 31st in the S&Ps, and it's trading 2650 for the puts, and it's trading just below 16. So it's 41 points for the whole of January, given the fact that we moved well, quite a bit more than that in a week. That is beginning to look very cheap, and we will certainly be doing some option strategies for you on Twitter starting on Monday, because certainly we could easily have a 30-40 point move higher than 2750, followed by a 50 to 60 point move below 2750, all within the space of this month. What is incumbent on me to say is, as you know, we're great believers in spreads and spreads determining the direction of the market. There isn't a single spread that we look at that is actually telling us that it's time for risk off. If you have a look at probably the most important one, XLP over XLY, it is constantly making new lows. This is a very bullish setup. It's a setup which says that risk on is very much ruling the roost. If I showed you any number of the other 30 odd indicators that we look at, it would be the same story. There is absolutely nothing indicating that we are in a period of risk off, or that we're even in the danger of arriving anywhere near risk off. So what we will be looking for, and what any sale is actually a technical reaction to overbought levels. That's all it is at the moment. The trend for all equity and risk is very much upwards, and that is still the result of all the same factors that have been present for the past X years. There is no change there, and there is certainly no change in the attitude of Japan or Europe towards QE, and that is what the market is still reacting to. It's reacting to all positive fundamentals. As we know, everything, including industrial production, PMIs, is still very much pointing upwards and accelerating, and the market is reflecting that. Next most important spread, SPY over TLT. It couldn't be more picture perfect. This is the picture of a bull market. It is just a volatile bull market, but still a bull market nonetheless. This has a lot more room to expand. It could go to the top of this line without any problems, indicating that if bonds are going to kill this bond market, this rally in equity markets eventually, they need to go a lot higher in yield. We're talking about, I don't know, above 4% in 10-year notes. And as you all know, we are nowhere near that level. This level of interest rates is just not going to kill the risk-on market. If we look at 10-year notes, we are just flirting with this very important level that the line's been there, 248.90, so basically let's call it 2.5%. It's just completely flirting with it and doesn't have the energy to go above it. We think it will do in a few days' time. It will break it, and then it will go to the really important level where we stalled out a couple of times, which is just above 260. That is the magic level. We break 260, we are in a completely new ball game, and we can absolutely accelerate higher. Not saying we're going to do it. All I'm saying is that we know what the levels are. We know that any close above that level is going to be quite dramatic, and it is the thing which could prompt the sellers to come in equities, and we could have our first 3, 4, 5% setback simply on the back of the sellers have come in. There are very few buyers underneath. The market goes down 100 points, and then it settles down and starts the grind up again. It is always incumbent on us as traders to think of what could derail our picture of what the markets are doing. Well, the dollar is always the thing that could derail it. If the dollar index now started going above these levels and breaking these trend lines, then we would get worried that the sellers could come in heavy in US equities. This is a picture which is completely unconcerning at the moment. It is unlikely to go above 93.63. Any retracement is going to be contained by that until we start closing quite a bit higher. So that is our sell level, and we still think that we have at least one final leg down towards 90. So at the moment this is an unconcerning picture, but something that we always follow just in case it starts derailing our main view. One final chart to see confirmation of this bull market is from the transports. beautiful uptrend. Yes, overbought, fine. But what I'm trying to tell you is that although everything is hugely overbought, and although there will be volatility back down to these lines below 2700 or potentially even lower, it is not because we are going to encounter a period of risk off. It is just because it is a normal technical reaction within an uptrend. So at the moment we see in the spreads or in the transport or whatever else we follow as an indicator of early risk off, absolutely nothing to concern you that anything has changed and that this is not a buy the dip market. It's just beginning to not be a buy a 3-point dip, because at these levels we could easily have a 100-point dip and it would mean absolutely nothing but a better buying opportunity. And let's have a quick look at our friend the commodities. All these indices, as you remember, this one is the least susceptible to energy, to the most, are beginning to form the beginning of the early stages of an uptrend. As you can see, our favorite one, DBC, is now at very, very important levels. It's going to take many, many weeks of this kind of performance to turn the moving averages. So we are in a period of accumulation. Any drop in commodities down towards the 1530s to 1550s is to us let me enlarge this for you, is going to be a very interesting area to accumulate. We could easily now, because we can't finish above 1671, we could easily have a 3 to 4 week dip back down below 16, certainly an accumulation area for the next leg that we expect to touch 18. Commodities and real assets are something that are bound to go up in the next couple of years and that we should really be accumulating. If you needed a final confirmation that we are in a risk on period, well, this is emerging markets. We have been in basically a decade, but longer than a decade long downtrend in this channel. We are now firmly breaking it. We've been settling above it for best part of 2 months. We are vastly overbought, but that is something that emerging markets do. They when they move, they really move, and they stay outside the Bollinger Bands for a long time. So emerging markets are yet another sign that we are of course in a period of risk on, a period where if you're long of emerging markets, you hold on, you take some profits, you wait for it to come back after a few weeks. But this is a picture which very much says that we will at some stage test above 50 in emerging markets, and when we do that and break it finally, probably towards the middle of the year, we'll be off to the races. As far as the biases for next week, we are sellers of any rally in the futures in the 5 and 10 year notes of Bunds and Bobble. We have our levels and we'll tweet them for you. Commodities, any dip, we are buyers, and basically we see no sellers. We're at the monthly top, but we can go 1 or 2% above the monthly Bollingers without any problem, and that is the time to buy the straddle, because you could have either a continuation or a complete 3 to 4% drop, in which case you make a lot of money out of volatility. We have those levels. We shall definitely tweet them for you. NQ is the one that I really wouldn't be short of at any one time, simply because it could really accelerate. It could move 10% without any problems, simply because it is still the most undervalued sector if you have a look at those blue angels I showed you earlier. We are watching volatility as opposed to equity prices. The fact that we're holding on Friday indicates that options are an interesting play for the next 3 weeks. And the super cycle is still working. Emerging markets are now making very much new highs and will be, in our view, since they are so much cheaper than the US, will be the refuge of the Tina crowd. People will loathe to buy above 20 forward earnings in the States when they can buy 12, 13 forward earnings in emerging markets. Unless the dollar breaks 93.63, we see absolutely nothing concerning in the dollar index, with our target still at 90. And XLK, as we showed you before in NQ, unless we can settle below 64.80, mark that level on on any daily pullback, it's unlikely that we do not go parabolic, i.e. Quite a bit higher, certainly in the 70s, and that is the big danger, and that is why we think volatility actually is going to make money for you on the way up and on the way down. Thank you very much indeed. We will tweet you all those levels next, starting on Monday, and have a very nice weekend.